So lately, there have been reports that Jerome Powell and the Federal Reserve are poised to slash interest rates in the next few months. The Federal Reserve's decision on interest rates are closely watched by investors, businesses, and consumers alike. When the Fed cuts rates, it can have wide-reaching implications across various sectors of the economy. Hey, I'm Luke, an advisor here at Simmons Capital Group, and today I'll discuss a few things you can expect when and if the Fed cuts rates. So first is lower borrowing costs. So if interest rates go down, you're likely to see lower mortgage rates, making home loans more affordable. This could be a great opportunity if you're looking to buy a house or refinance your current mortgage. We have recently seen mortgage rates fall below 7%, which is an encouraging sign for new home buyers. For business owners, lower interest rates can make it cheaper to borrow money for expanding your businesses, investing in new projects, or covering operational costs. This can be a fantastic chance to grow your business and invest in its future. Next is increased consumer spending. So lower borrowing costs mean that you'll have more dispensable income as you'll spend less on interest payments. With extra money in your pocket, your spending can increase. This uptick in consumer spending can drive economic growth since consumer expenditure makes up a significant part of the gross domestic products, or GDP. Or, if you aren't the spending type, perhaps this will give you more money to save. American households are back to pre-COVID savings rates, and so a little extra money can help build back up that rainy day fund. Next is the stock market reaction. So lower interest rates can be great for the stock market. Since savings accounts and fixed income investments offer lower returns, you might look to the stock market for better gains. This shift can help to drive up stock prices. Additionally, businesses benefit from lower borrowing costs, boosting their profitability and positively influencing stock valuations. Next, we have the bond market effects. So when interest rates are cut, newly issued bonds usually have lower yields. This means that existing treasury bonds with higher interest rates become more attractive, which can increase their prices. And corporate bonds may also become more appealing, though the reduced yield might push some investors to look for higher returns and riskier investments. Next, we have the inflationary pressures. While rate cuts can stimulate economic activity, they can also lead to higher inflation if demand outpaces supply. The Fed must balance stimulating the economy with keeping inflation in check. Another impact we might see is savings and fixed income investments. Lower interest rates reduce the returns on savings accounts and fixed income investments like CDs and bonds. This can be challenging for savers, especially retirees who rely on interest income. They may need to seek alternative investment options to achieve their income goals. When the Fed cuts rates, it can have a broad and multifaceted impact on the economy. Lower borrowing costs can stimulate spending and investment, boost the housing market, and drive stock prices higher. However, it can also lead to a weaker dollar, lower returns on savings, and potential inflationary pressures. Understanding these impacts can help consumers, investors, and businesses make informed decisions in response to changes in monetary policy. Here at Simmons Capital, we understand that these concepts can be confusing and quite overwhelming. So if you ever have questions about how this could impact you and your portfolio, feel free to give us a call at 518-406-5624 to speak with one of our advisors.